Hi, my name's Alex. I'm a CPA with Stronghold Accounting. My background is auditing public companies. Now I help small businesses optimize their profits through accounting and advisory services. And if you're a business owner wanting to increase your profitability, this, in my opinion, is the number one metric to drive that change, especially if you have employees or you're a service-based business trying to maximize profitability. Labor efficiency is one of the most helpful indicators to boost profitability. So what is labor efficiency? Because this is not something that a lot of people talk about. It was coined by Greg Crabtree, who wrote the book Simple Numbers, which if you haven't read as a business owner, amazing resource. So what is labor efficiency? Labor efficiency is saying for every dollar that I spend on my employees, my direct labor, what is the margin that I get after my costs of goods from that revenue? So for example, I have an example P&L here. I had revenue of $1.5 million. My cost of goods for that revenue was $707,000, meaning what I call product margin, right? Not including any labor. My revenue minus my hard cost of goods sold was $827,000, right? Which is about 54%. Okay, but my direct labor to produce that revenue was $414,000, which means direct LER, by the way, means labor efficiency ratio. So what this formula is doing, this 2.00 or $2 is saying, hey, it's saying the product margin of 827,000 divided by that direct labor of 414,000 is essentially saying for every dollar in direct labor I spent, I got $2 in product margin back, revenue minus cost of goods sold. So it's a really easy conceptual way to think about the production of revenue after cost of goods sold, considering your direct labor. So $2, right? Now I want to do a thought exercise with you because the target for this is going to be different based on the company's size and industry. But I want to say, okay, so with this margin here, the net income of the company was, let's just say $36,000 in this scenario, right? So I'll put it up here, $36,000. Now, what if we were able to change this direct labor efficiency from $2 to $2.50? How big of a difference do you think that would be to the profits? Let's go ahead and go through the numbers. It's simple math, right? So instead of $2 of our direct labor efficiency, I want to produce $2.50. So what I have to do is I'm going to say, okay, instead for the $414,000 I spent on direct labor, if I multiply that by 2.5, that means that instead of $827,000 in product margin, I would have produced, let me just fix this here. I would have produced about $1 million in product margin. Okay, great. So what's the difference between this million minus the 827? That means, and from going from a direct labor efficiency of $2 in margin for every dollar I spend in direct labor, I now am at $2.50 for every dollar in direct labor. That increased my profitability of the business, and we're just talking gross margin here, but this will flow into your net margin of $209,000. And this is just this is based on a sliding scale, right? So if your company's bigger and you leverage that labor efficiency, I mean, come on, you're talking about hundreds of thousands to millions of dollars in increased efficiency. And it's like, okay, great, Alex. If I knew that, I would have already done that. But here's the thing, it's the Hawthorne effect, right? If you don't observe it and you can't measure it, it's very hard to grow it. So think about getting your team on board with understanding direct labor efficiency. How impactful that could be if they understood for every project they're on, they need to generate $2.50 for every dollar in labor you pay them. And let's say you put a small bonus based on that performance on that. The change that you can make just by knowing this number is more than you think. So how do you improve the number? How do you actually improve the labor efficiency? Well, there's two ways. You obviously have to increase your margin, your revenue minus your cost of goods for every dollar of direct labor you spend, or decrease the amount of direct labor you spend for every dollar of product margin. So it's an efficiency game. It's a hiring, it's a firing, it's an efficiency game based on performance metrics. incentivization. How do you become a more efficient business overall? But without this metric, there was no way to measure that before. So in my opinion, this is one of the best metrics to drive the business profitability, going from $2 in product margin for every dollar in labor to $2.50 yielded over $200,000 in profit in this example scenario. Mind-blowing stuff. So if you're interested in this, interested in knowing your direct labor efficiency, what your target labor efficiency should be, fill out a financial health assessment application. We're going to take a look at your QuickBooks file, look at any red flags, any opportunities, and give you a proposal of what it looks like to work with us, along with a nice summary of a health assessment of your current QuickBooks financials. Go to strongholdassociates.com/free consult if you're interested. Again, my name's Alex. I help small businesses optimize their profitability, and thank you for watching.